Hello everyone, here is Ali Talebi. We're going to have some finance classes together. Our goal here is to enjoy finance and learn it faster, easier, and using a simplified approach actually. So here is the structure of these lectures. We'll have several modules and each module contains a few lessons. For example, the first module has 3 lessons. At the end of each module, I will provide some hints and I will mention some common mistakes, and also I will provide some information regarding avoiding those mistakes, as I mentioned at the end of each module. And also at the end of each module, I will provide you some questions which are more kind of review questions, just to make sure we understand the concept we covered during our lessons. This is how the lessons and the modules are structured. Each lesson will take about 10 to 15 minutes, so we'll just make it short. Feel free to provide your comments and questions underneath of these videos, or you can send me your questions directly. I will answer your question as soon as I can. So, as I mentioned, we'll have several modules. The first module contains 3 lessons. And the first lecture will talk about the financial operations of the firm, and we are going to answer actually this question: how do firms financially operate? Second lesson, we'll talk about different forms of corporations and firms actually, and when you're going to incorporate a business, what options you will have. So we'll talk about the advantages and disadvantages of those businesses. And finally, for the last lesson, we'll talk about the financial goal of the corporation. Corporations are one of the major form of businesses, so we'll focus on corporation. Most of modules and lessons are around corporations. Also, we'll talk about some other form of businesses, but as I mentioned, mainly will be about corporations. That's the last or third lesson of the first module. So let's start with the first lesson. The first lesson is regarding the financial operation of the firms. So, let's say you come to the point that you are going to have your own business. It doesn't matter what type or form of business you are going to launch. The first note here is you need to start with something. And what is that? Yeah, you're right. You need money. You need some source of cash, some source of money. So that's how we do. So you are going to get this money. How you can finance that money? Usually you have 2 major options. Either you go to the bank and you borrow the money from the bank, which you call that loan or debt. So let's just call this debt. So you are borrowing from the bank or financial institute. Or if you are a big giant corporation, you might consider selling your shares to public, or in some cases to private shareholders. So the second source will be what we call shareholders' equity. So you can actually get the money from some people. However, in exchange, you are going to give a portion or part of your company, so they become owner. And that's a major difference between debt and shareholders' equity. In the first case, there is no ownership. So those institutes or people who are lending money to your company, they don't have any claim in terms of your company. However, if you're talking about the shareholders' equity, those shareholders actually, they're looking for some sort of ownership. So let's call this financing sources. Okay, so these are how you finance actually your operation. So we call that financing. Now, when you get this money from through debt or shareholders' equity, so what happened? What happened next? What you need this money for? For sure, you need to invest this money. So you are going to invest. That's the question you need to ask yourself. On what? Generally speaking, we call that assets. So you invest the money you raise on assets. So what are those assets? For sure, you learn this in your accounting courses. You know, we are talking about cash, we are talking about properties, we are talking about accounts receivable, different forms of assets. But for now, just let's make it simple. Just let's call it assets. So, you have two major sources of finance. And for sure, you can go with different combinations. You can choose 20% debt, 80% shares. You can choose 50-50, or you can go with other ratios. We call the combination of debt and shareholders' equity capital structure. So how much is coming from debt? How much is coming from shareholders' equity? The combination is called capital structure. So whenever we say capital structure, it means how your operation is financed. We have the same type of idea for assets. You can choose different form of assets. Generally speaking, we have two sorts of assets: current assets and non-current assets. Current assets are those type of assets which you expect to convert into cash within a year or in short period of time. But when it comes to non-current assets or long-lived assets, you're talking about those assets which you're not going to sell them or convert them into cash within a year. For example, we're talking about equipment or property or land. These are type of assets which you are going to use them for a long period of time. So these are non-current assets. So the combination is called asset allocation. So again, how much you are going to allocate to current asset or non-current asset, that's the argument which is called asset allocation. Now, what is your goal here? You are running this business, you are going all these changes, all these troubles, challenges. So what is the goal? What's the objective here? You want to make more money, you're right. The goal here is if you have, let's say $10, you are going to make it $12. You are going to make it $15. That's your goal. So that's how you are going with this cycle from financing to investing. Your goal here is to generate more money, to add more value to your assets, to raise more money and go up and go up. Later, in the following lessons, when it comes to the major goal or objective of corporation, we'll talk more about this notion. We'll talk about the market value of shares, book value of shares. We'll talk about the stock price and all these arguments to show you how you can actually increase the total value of your company or corporation. But for now, we're going to wrap up. As I mentioned, we'll talk about the capital structure, financing. The combination of debt and shareholders' equity is called capital structure. These are two major sources of financing. Also, we talk about investing on assets and the options you have. You can invest on assets. Before wrapping up this section and actually finishing this part, let me remind you something. We talk about current assets and non-current assets. Most probably you heard about the term financial assets, physical assets, or sometimes called real assets. Maybe you say, Ali, what's the difference between real assets and financial assets? Are they same as current assets or non-current assets? The answer is no, actually. The real assets are those assets which are more tangible. For example, when we talk about properties, land, equipment, you say, okay, I can see them. I can see the value of them. You see what is the value in this equipment. So I'm working with this equipment, I'm going to produce these many items, and it helps me just to sell more and having more revenue. These are type of real assets, but financial assets are not those type of assets which you might see clearly. For example, when you talk about the stocks or bonds, those are still assets, but those are not real assets. They get or they derive their value from real assets. For example, you go and buy shares of IBM or Microsoft from the stock market, or you buy actually from a brokerage firm. Anyway, when you're buying the shares of Microsoft, you are not buying the real asset. You are not buying part of their equipment. What you're doing, you are buying the claim on their assets. For example, if you buy, hopefully you're that rich, if you're buying 10% shares of the Google or Microsoft, you have 10% claim on their assets. And to be more specific, remember, when you talk about assets, it means you are getting claim on debt and shareholders' equity. Because we know and we learn from accounting that when you talk about assets, actually assets are same as debt plus shareholders' equity. So in other words, when you are buying assets, you are buying debt and shareholders' equity as well. So we'll talk about this more, but here the point is to distinguish between real assets and financial assets. They are not the same. Thank you very much. Have a wonderful day. This is Ali Talabi, and talk to you soon.